Let's get some reaction from our panel. And I'll kind of go in reverse order from what we just heard. Jim, here you hear it, the stagflation.
Yeah, so the unemployment rate came up, right? So I think this is something that is somewhat, I wouldn't say new. I mean, inflation is not new. Inflation, we know, has been stubbornly high. But now that the Fed is starting to really comment on the unemployment rate, this is really the key. So look, everybody looks for the quote-unquote Fed put in the markets. I think the Fed put is probably struck around a 4.5% unemployment rate, or at least a movement towards that level. So unless we get a significant deterioration in the labor market, then it's hard to have a deterioration in the overall broader economy because, you know, consumption is 70% of GDP, and that comes from labor. People have wages to spend. So ultimately what I think is happening here is that the Fed is really waiting to see if corporations in these earnings calls are going to start to now lay off workers as a result of this. If they don't see that and the labor markets stay relatively resilient, then we may be kicking the can down the road on rate cuts for a while longer. But we have to wait and see, and that's the point.
Yeah, the market's initial read here is kind of similar to what we saw going into. We're not seeing any big dislocations right now, but it's early. Stephanie, what's your take?
Yeah, I think this is an important change in the sense that it tells us they are concerned about inflation being persistent. So, you know, a couple of weeks ago when Chair Powell noted that inflation might be transitory this time, they are certainly walking that back and more, which tells us that the Fed might be a little bit more hawkish than would otherwise be the case. They are certainly going to be in no rush to cut. They're not going to do preemptive cuts, that's for sure. They're going to have to wait to see real economic weakness, which is the unemployment rate rising, say, towards that 4.5% or higher.
Yeah, there's the 10-year Treasury, about 4.275, so dipping a hair. David, what are you looking at?
Well, I think it's very, very interesting. I mean, the first thing is I think it tells us a little bit about what sort of message Jay Powell is willing to put out there. I mean, he does seem to have a certain tunnel vision. He's trying to ignore what's coming in from the other side of Washington because, frankly, you know, I think it's sending a shot across the bow of the administration saying, essentially, if you read between the lines, your policies are leading to higher inflation, higher unemployment. Now, having said that, I do think that, you know, the language on higher inflation kind of makes sense because the April 2nd tariff announcements, which are much higher than people expected, they were since the last meeting. So, yes, that part of inflation's gone up. The one thing I'd caution on is unemployment. We've got such a reduction going on in immigration, we think, that it may dampen down any increase in the unemployment rate. So I tend to agree with it. You know, this is a somewhat hawkish statement, and it says we're not going to be in any hurry to cut rates because, honestly, there are risks to both sides of our mandate here, and we're not sure which way we should be playing this.
Brian?
Yeah, I guess I'd go to Steve Leisman on this because it is a little bit vexing. Yesterday, obviously, Kelly, you had David Zervos on with Power Lunch talking about a 0.5%, you know, 50 basis point rate cut. You know, Steve, tomorrow we're going to be at the Port of Long Beach, kind of looking at incoming traffic from China, exports, imports. You've done amazing research and reporting on how much all this tariff stuff may impact GDP and the U.S. economy. And yet the Fed today, I don't want to say is ignoring that, but with no rate cut, do we read into this that Jay Powell and his team maybe think the U.S. economy is holding up better than some thought, at least for now?
I'm just wondering, Brian, when you go to the Port of Los Angeles, or Long Beach, will there be anything to see there? What are you going to film? Apparently, there's no. All the ships are coming in empty, and I say that it's not even a funny thing in the sense that that's a big part of the outlook. I want to just address real quickly what David Kelly was saying. David, the Fed is not saying anything here that we haven't picked up in our CNBC Fed survey that other people who have done surveys of the outlook of forecasters are picking up, which is that indeed the risk of higher unemployment and higher inflation are both the case right now. We have had in our last survey, our Fed survey we did on Tuesday, both of those went up and went up meaningfully to 4.6 on the unemployment. And it really gets back to the conversation that Jim was sort of having with himself, which is the one that I think every investor is having with himself, which is given those two facts, which is the one the Fed is most likely to address? Now, you can make a bet that it's going to be on the unemployment side. I don't think, Brian, that the Fed is ignoring anything here. I think they see palpable risks to both sides of their mandate. You're going to have an increased tariff on every imported product in this country. By the way, that's not something other countries will be facing. And you're going to likely have increased unemployment because a lot of the people, Brian, involved in the jobs that you're going to look at tomorrow, their jobs are in jeopardy in part because of what's happening at the Port of Long Beach.